How many of you want to invest in speculative, high-risk investments just to generate your retirement income? How many want to dip deeply into your savings or sell investment assets just to maintain your lifestyle? Or how many want to pay more tax on your retirement income than ever necessary? The answer is nobody. But unfortunately, without a proper income plan, these scenarios are all too common. Like the elderly gentleman I met recently, this person was extremely unhappy and disappointed. A broker sold him a product that promised a guaranteed income for life. According to him, the broker never thoroughly explained that once he passed away, his widow would only receive half of his original income. And once she passed away, their 4 children would get not a single cent. This client came to me because he was diagnosed with a terminal illness, and he was desperate to make a plan to ensure his wife was adequately cared for once he passed away. Hello everyone, and welcome to the Family Wealth channel. Thank you for joining. My name is Hardy Swart. I'm a certified financial planning professional and a director at Family Wealth Custodian. Please note that the information presented in this video is hypothetical and intended for educational purposes only. It does not constitute personal financial advice. So if you need advice tailored to your unique circumstances, please contact a certified financial planning professional to help you with your unique financial planning needs. Often, when engaging with clients who are approaching retirement or at retirement, I would ask them the following. How many paychecks do you think you've earned before retirement? And how many times would you need to pay yourself after retirement? This is actually simple math, but if you start working at the age of 25 and you work up until the age of 65, that equates to about 40 years. Thus, if you earn 12 monthly paychecks, you would earn roughly 480 paychecks over your entire working life. However, the scary realization is that if you retire at age 65 and live until the ripe age of 95, then you would need to fund yourself for 30 years. That's 360 paychecks that you have to fund yourself in retirement. Step 2 of the Retirement Master Plan is all about income planning, and it's essential. When we craft your retirement plan at Family Wealth Custodians, we integrate steps 1, 2, and 3 simultaneously: asset allocation, income planning, and tax planning. No one wants to face the scenario I mentioned earlier, so we aim to build a plan that includes multiple income streams. We want you to withdraw a reliable income while preserving your capital and keeping up with inflation, ensuring your income grows throughout retirement and making it as tax efficient as possible. It is essential that your income plan aligns with your estate plan. This will ensure that your retirement income is available for your spouse and loved ones once you pass away. There's a moment of realization before or right at retirement that we call the aha moment. It's when you understand that your regular paychecks have stopped and you must figure out how much income to draw and when to draw it and where to draw it. You'll start to connect the dots: how to handle taxes, when to tap into retirement annuities or other retirement savings, and when to begin drawing from your company pension fund. That's why retirement income planning is more complex than saving during your working years. In this video, we'll explain what retirement income planning entails. You might think it is as simple as just withdrawing a fixed percentage from your savings, but there's much more to it. We'll introduce concepts that you need to understand. Whether you decide to work with us or manage your own retirement plan, our goal is to help you build a better retirement income plan. So although income planning is followed by tax planning in our process and the Retirement Master Plan, they are actually closely intertwined. Without investments, there's no income, and without income, there's no taxes. Thus, we plan for both aspects together, exploring various scenarios to optimize your income while minimizing taxes. It's not about how much you earn, but it's actually about how much you keep. To help us illustrate this, let's run through some financial tools and how they are taxed in South Africa. For example, if you invest in a unit trust, income from a unit trust is subject to income tax, while capital gains are taxed at capital gains tax rates, CGT rates. Understanding the tax implications when you sell units is important, as it affects your overall income. Dividends. So dividends are subject to dividend withholding tax. It's crucial to factor this into your income planning, especially if you rely on dividends for a significant portion of your retirement income. Bonds. Interest from bonds is taxed at your marginal income tax rate. This interest received annually will be added to your income and taxed accordingly. However, remember there's an annual interest exemption that slightly increases once you're over the age of 65. Annuities. Payment from retirement annuities are taxed as income. Knowing the different type of annuities, life annuities versus living annuities, and fixed annuities versus variable term annuities helps you select the right one for your specific needs. And then something like rental income. If you own a rental property, the rental income is taxed as part of your regular income at your marginal tax rate. However, you can deduct certain expenses related to the property, such as maintenance and bond interest, which can help you reduce your taxable income. Rental properties can provide a stable income stream, especially during retirement, but it's essential to consider the ongoing maintenance and management and the potential risks involved with having a property. Then there's a tax-free savings account, or TFSA. Income generated within a tax-free savings account is not subject to tax. This includes interest, dividends, and capital gains. Tax-free savings accounts can significantly enhance the tax efficiency, making them an excellent tool for retirement income. Endowments or sinking funds. Income from endowments or sinking funds is subject to tax, but this tax is typically lower than the individual's marginal tax rate, as these are taxed within the fund itself. Understanding the timing of withdrawals and the associated tax implications is crucial to optimizing your income from these different sources. Knowing how these tools are taxed helps in deciding which accounts to place your funds in and when to change the necessary allocation in order to maximize your income. When planning retirement income, we map out the optimal timing to drawing your income from various sources. For instance, one might start accessing retirement annuities earlier while deferring other investments to maximize benefits. We also look at tax-efficient strategies for withdrawing from retirement accounts. Let's put it all together. Income planning aims to ensure that you have reliable, increasing income throughout retirement. We aim for tax efficiency, making a large portion of your income tax-free over time. As we build your retirement plan, we align your income strategy with your tax planning to maximize your financial security. The first step in income planning is to assess your income needs. This involves a detailed analysis of your current and expected expenses. Consider costs such as housing, utilities, healthcare, travel, and leisure activities. It's essential to account for inflation, which can erode purchasing power over time. Next, identify all potential income sources. This includes pension funds. It's important to understand the benefits from your employer's pension scheme and when you can start drawing on them. Retirement annuities. Knowing the tax implications and the rules around accessing your retirement annuity funds is very important. Investment income includes dividends, interest, and capital gains from your investments. Rental income. If you own rental properties, factor this income stream in as well. And then things like part-time work. Some retirees choose to continue working part-time, which can supplement their income. The third step is all about timing your income. Timing is crucial when it comes to income planning. Determining when to start drawing from each income source to optimize your tax situation and ensure you have a steady cash flow is super important. For example, delaying the withdrawal from your retirement annuity can result in higher payouts at a later time. The fourth step is all about tax planning. This includes strategies like splitting income between spouses to take advantage of lower tax brackets and using tax-free savings account effectively to optimize your tax strategy. Also, depending on your unique circumstances, withdrawing and reinvesting the tax-free portion of your retirement savings can benefit the overall tax that you pay. Understanding the nuances of the South African tax system can help you retain more of your hard-earned money. Let's take a look at a case study to illustrate how income planning works. So John and Sally are a married couple aged 60 and they have the following combined assets. So John has a retirement annuity worth approximately 3 million rand. He has a tax-free savings account of 300,000 rand and an investment plan of about 2 million rand. Then Sally, on the other hand, has a retirement annuity of approximately 2 million rand, a tax-free savings account of 300,000 rand, and an investment plan of approximately 1 million rand. Furthermore, they have their primary residence. This is a lifestyle asset because this is the home where they actually live. This property is valued at about 5 million rand, and then they have a rental property of about 3 million rand. Furthermore, between the two of them, they earn a combined rental income of 240,000 rand a year, which they split because the property is owned 50-50. 120,000 rand of that money is earned by Sally, and 120,000 rand of that amount is earned by John. The first step is to assess their needs. John and Sally estimate that they need approximately 60,000 rand a month to cover their expenses, adjusted for inflation, from the age of 65 until 80. John estimates that they need 40,000 rand per month to cover their expenses, adjusted for inflation, during the age of 80 until the end of life. The second step is to identify their income sources. They plan to withdraw from the retirement annuity starting at the age of 65. Furthermore, they plan to withdraw from their tax-free savings account also starting at the age of 65. Additionally, they will continue to receive 20,000 rand per month rental income from their rental property. The third step is about timing their income. John and Sally will start drawing from their retirement annuities at the age of 65. In the meantime, they will use their discretionary investment accounts to cover the gap. Their rental income from the property they own will also contribute 20,000 rand per month, which helps them cover their shortfall and reduces their need to draw heavily from their investments early on. They will also minimize their tax burden by splitting their income and taking advantage of tax-free savings. Deducting allowable expenses offsets their rental income, further reducing their taxable income. Income planning is much more than simply withdrawing a fixed percentage from your savings. It involves understanding the types of investments you have, timing your withdrawals, and optimizing your benefits. It is a critical part of your retirement master plan and directly relates to tax planning, which we'll cover in the next episode. Thank you for joining us today. Stay tuned for our next video on tax planning, followed by healthcare planning and estate planning. If you found this video helpful, please give it a thumbs up and share it with others. Subscribe to the Family Wealth YouTube channel and hit the notification bell so you never miss an episode. Thank you for watching. I'm Hardy Swart, and until next time, keep investing in your future.